I'm Roger Montgomery and welcome back to this week's Video Insight, where we cut through some of the market noise to bring you a little clarity. Today we're discussing a market that's climbing a wall of worry like never before. Should you buckle up or step aside? Let's start with the big picture. By July the 1st, the MSCI World Index was sitting pretty, surpassing its pre-Liberation Day peak of April the 2nd. That's right, global equities are rallying despite a geopolitical storm that would have sent markets into a tailspin at any other time. Think about it. US tariffs projected to hit 15% or higher, 3 simultaneous Middle Eastern conflicts, and direct US military strikes on Iran's nuclear facilities. Any one of these would have spiked oil prices, strengthened the dollar, and crushed equities in the past. Yet, here we are, markets are up. Why? Well, globally, investors are shrugging off short-term inflationary risks and focusing on the upside. Global earnings forecasts are climbing, with dividends projected to rise over 10% this year. In the US, share buybacks are hitting record highs, and in Europe, despite the Ukraine conflict and Trump's push for higher defence spending, the euro is stronger and equities are rallying. Investors are betting on the positives, such as a moderate tariff regime reducing the US trade deficit, now at nearly 5% of GDP, and the muted economic fallout from the US strikes on Iran. Oh, and get this, oil prices are down 20% from last year, and the US dollar, it's down 10% in 2025. Closer to home, Australia's market is riding the same wave. The NAB's June 25 business survey revealed a surge in trading conditions, profitability and employment. Business confidence is at its highest in over a year, with capacity utilisation and forward orders also trending up. Even Macquarie Research, once cautious, is rethinking its approach to PE ratios, especially for banks. They're saying this cycle's different. I think I've heard that before. So is this rally too good to be true? Let's talk warning signs. In the US, fiscal deficits are ballooning, with Trump's Big Beautiful Bill Act projected to add $3 to $3.4 trillion to the national debt over the next decade. Moody's downgraded the US credit rating in May, and that's not all. Equity exposure amongst CTAs, or commodity trading advisors, is at the 89th percentile, meaning we're seeing stock investments at levels higher than 89% of historical periods. Retail investors are also piling in, with their trading share hitting 14%, the highest since 2018. And get this, they've got over $1 trillion parked in just 3 stocks: Nvidia, Apple and Tesla. And then there's the AI bubble debate. The top 10 S&P 500 companies, many AI-driven like Nvidia, Meta, Alphabet and Microsoft, are trading at forward PE ratios of 28 to 30 times. That's higher than the dot-com peak in 2000. The S&P 500's overall PE is 21 to 23 times, not as wild as the Nasdaq's 90 times in 1999, but the concentration in AI megacaps is raising eyebrows. And then there's Palantir, trading at a jaw-dropping 102 times sales and 423 times earnings. Of course, the counter-argument is today's AI giants aren't the unprofitable dot-com startups of 2000. Nvidia alone generated $28.5 billion in cash flow in the first half of 25. Alphabet and Microsoft have diversified revenue streams and dominant market positions, plus falling interest rates in 2025 are a tailwind for growth stocks, unlike the 7 to 8% rates that choked liquidity in 2000. But don't forget, Apple's recent research shows advanced AI models' accuracy collapses to 0 on complex real-world problems, raising questions about their long-term value. So what's the solution? Well, this market's resilience is impressive, but there are warning signs. Valuations are stretched, fiscal risks are mounting, and the AI hype might be outpacing reality. My take? Stick to quality, diversify across asset classes including private credit, and don't get swept up in the euphoria. Well, that's all we've got time for today. Continue to follow us on Facebook and X, and if you found this valuable, hit the like button, subscribe, and share your thoughts in the comments.